Welcome, Drew.
Thank you so much for having me.
Yeah, we're very excited because you've just recently moved
Yes.
offices
Yes.
with CrossCountry Mortgage. Is that right?
Correct. Yeah.
Okay. So, Drew, I've known you. I was telling Ellie before we got on the air that I think when I originally met you, you were with Chase Mortgage and then Caliber and Thrive. I mean, I know you've been, so that means I've known you for about 20 years.
Yeah.
Which is amazing because while agents and realtors and lenders all change companies throughout the course of time, it's great to have that relationship because you as a person stand out. I'm just going to give you a personal plug here.
Appreciate that.
You stand out. I know that you're somebody that I can call, that my clients can always talk with, and you're pretty straight up front, and you tell them if this is a program that'll work for you or maybe this isn't. But I also like the idea that you also think outside of the box. So I'm going to set you up there and let you go to tell us some things.
And that's been pretty important to me through my entire career. If it's something, if there is a program that another lender has, with the permission of the original referral source, so in this case you, if I know that there's a program that's just going to be so much better that's offered by somebody else, then I'm going to usually recommend it.
Right.
To do that transfer. That was also part of the reasons why I went to CrossCountry, is because I was coming up against my friends at CrossCountry and realizing that they had these programs that I didn't have, and my company at the time was not looking to develop. And I really wanted to have every opportunity for first-time home buyers. I mean, that's been my passion, is helping out first-time home buyers, helping with democracy in housing. I mean, that's a big, important part of my personal mission. And so that's really, when I looked at what they could do at CrossCountry, it just seemed like it was a good fit for me, and the branding and everything like that just really worked well for me too.
Well, that's great. And I think that's really, when somebody changes their business, it's for the purpose of being able to better serve their clients. I think that speaks volumes. Some people will change because, I get more money, or I don't have to pay as much to be here. But if the change is I can give better service to my clients, I can do more for them, I say kudos to you for doing that.
Absolutely. Yeah. And it wasn't more money, as a matter of fact, because I mean, it's, in the mortgage industry, it's pretty much everybody's about paying the same.
Yeah.
So, it was culture at the new company. And what was great too, is that I got an opportunity to be immersed in the culture, because we had this big sales rally right after I went.
Oh.
So I got to meet all of these top producers, and I went to a top producer panel at my company, and so many times I've heard of top producers in mortgage specifically saying, your whole goal is to get out of talking to clients, get to the point that you just want to scale it up so that it's just so big, so you have all these people working for you. And I've never identified with that, because it's like, I really like to talk to clients. That's what I do, and that's what energizes me. And so they had a top producer panel, the top 3 people at CrossCountry, and CrossCountry is the largest mortgage lender in the country, and all 3 of them said they still meet with clients.
Oh, that's great.
They've scaled it up. They do have teams that take a lot of the back end stuff, but they still want to meet with clients, and they say that they're back-to-back meeting with clients or realtors, or they're out there networking or giving back to the community too, because I mean, you and I know we've both been pretty big in community giving back.
Sure.
That's another reason how we've connected, because of our community-minded focus too.
Right.
So.
Absolutely. And being able to do something more, right? Again, I think those connections that you make, that relationship that you build, is so critical. It's not just about networking and who do you know, but it's about understanding the background of somebody. Ellie knows that she can trust me. If she needs something, she's going to ask me, who do you know that I can call, right? But she has trust already built into there because of knowing what our standards are, that we want to work with people that have the same ideas.
Yeah. I always tell my referral partners and agents who happen to be friends that I want to be that, a point of contact for you, even if I'm not helping with that particular loan, or I don't have that client, or I have no crack at that client.
Right.
I'm fine with that.
Right.
If somebody calls me and says, hey, and I get these calls all the time, hey, this is have
I'm
you
pretty
heard?
sure I've done that a
Yes.
few times.
Have you heard of this specific situation? I
Mhm.
had one just last week that was very, very, very weird. And I said, I've never heard of that. But here's some of the things to take back to that loan officer and say, okay, have you thought about this? Have you thought
Mhm.
about this? Because they were within a few days of closing. It did not make any sense. I knew that I could have easily taken it over,
Right.
but it didn't make any sense. It
Right.
made more sense for me just to give my expertise and say, okay, take it back to the original loan officer.
Mhm.
And then because I don't want to put somebody through that either. I
Right.
don't want to put a
Start
client
all
through
over
that
through the
to start.
process, right?
Right, because the worst thing that I can think of when is particularly a first-time home buyer having that the
Mhm.
housewarming party, and there's 4 other potential first-time home buyers there, and they say, "Hey, I'm so glad I did it, but oh man, it was a lot of work." And then
Right.
3 of those 4 are going to say, "Well, I'm not going to do it."
Right.
Yeah, so I'm going to hold off.
Especially in this market where
Yes.
they're already struggling with everything else.
Yeah.
One little negative comment about how difficult the process was, or I never could hear from anybody, I had no idea. Any of that is a reflection on our whole process, regardless.
Totally.
If we weren't responsible for it, we're still involved in it.
Totally, yeah.
Yeah.
And I mean, with some legislative stuff that's happened recently, I think that the whole industry is under a little bit of a microscope, and so
Mhm.
there's 99.999% of the people in the industry have been doing things right, and we need to continue to put a spotlight on that,
Right.
on that it's not about the paycheck. It's about helping people and helping people buy houses. And I mean, that's really the American dream, right?
Absolutely.
Is homeownership, is that first home or that subsequent home, the last home, or investment properties as well.
Right. And I think that's really the driving force, is making sure that there are programs that are out there that work for everybody's unique situation, because there are no two people that are the same. I don't care if they work at the same company and they're about the same age. Their situation is going to be totally different things. So having the people who are connected with them in the process that doesn't see them just as a dollar sign, sees them as a person, and then has the foresight to say, ask the questions, or go to a friend and ask the questions, right? And make sure confirming information is accurate and working best for them, and ultimately going to get them into the home.
Yeah.
We want everybody to be able to live in a home, whether they're renting or buying or selling it and moving on to something else.
Yeah.
We want everybody to be able to meet those real estate needs.
Yeah.
Awesome.
So you talked about programs, and that's one of the reasons you switched to CrossCountry
Yeah.
Mortgage. Can you expand on that?
Yeah, so we have some great first-time homebuyer programs that offer some grants, $2,500 in free money for people at or below a certain level of income, and then we offer up to 2 points or 2% of the loan amount for people who fall into a different bucket for first-time home buyers. And then the other area that we have some really great programs for is for those people who are purchasing a home and haven't sold their existing home. It's super competitive. It still is super competitive for buyers. It might have loosened up just a little bit, but it still is. And so, and Tammy can attest to this, doing a contingent offer, which is an offer on a new home contingent on the sale of your home, is going to put you at a real competitive disadvantage. The company that I was with before had one program that kind of worked okay for it, but it was a little clunky. And so my current company, CrossCountry, has really 2 great programs. One is a traditional bridge loan. And I'm actually doing one for a client right now, and it's great. So it gives them up to 4 months to sell their home. They tap into the equity of the home that they're selling to put down on the new home. They just need to qualify with the existing mortgage payment, the new mortgage payment, and calculation of the bridge loan payment, even though they're not going to have a payment for that 4 months. And in this market, 4 months should be plenty of time for them to close. And we'll also look at, we're not going to be foreclosing or anything if they take longer. We can always look at changing it up slightly. So That helps a lot. And then we have another program called Homelight, and Homelight is for those people who wouldn't necessarily qualify with the payments. So they wouldn't qualify with the traditional bridge. They wouldn't qualify with the two other payments, and it uses the equity in the existing home as a guaranteed sale. So that particular program has been around in some way, shape, or form for a long time. It's been under some different brand names, but this one, and it's a last ditch effort because it is expensive, to be completely honest. Any of those accommodation, accommodation programs can be a little bit more expensive, but they help those people who just can't afford to purchase the new home without the sale of their home, or to do a traditional bridge. So that's just some of the programs that we have. We also have some great programs to help those people who don't fit into the traditional credit box. And this is in no way, shape, or form the old days, the Wild West of mortgage lending, which some of us witnessed prior to 2008, 2009, when the mortgage market melted down. This is still responsible lending. We call it Signature Express, but it's non-qualified mortgage loan programs. So it's using either bank statements or just the income from the subject property to qualify for the new mortgage. So if you're doing an investment property, and I've helped quite a few people with this particular program, they call it debt service coverage ratio, or DSCR. All you really have to qualify with is the income from the property. So a rental property should cash flow greater than 1-to-1. So in other words, your outflow for your mortgage should be lower than what your should be lower than what your rent is. Ideally, as an investor, and Tammy can attest to this too, you want it to be more like 1.25. So you want your income to outpace really any of you. If you're just taking just your mortgage, you have so many other expenses that you're going to have,
right?
And you're going to be underwater. So getting to that 1.25 is really ideal. But as long as the subject property cash flows on its own, then that's all that is required, down to a 620 credit score.
So when you do those, do you already have to have a lease in place?
You don't. And that's a great question. So if you have a lease, that's fantastic. You can use that. So if you're buying a property that already is a rental property and it has a lease and they're just going to transfer it to the new owner, that's great. But in many cases, we see that somebody's buying a vacant property and they're planning on renting it, and it may not have been traditionally rented. And right now, because rent is going up and up and up, we're surprised that even some of those leases that may not have been reassessed in a while could be half of what the actual income could be.
Right.
So in those cases, even if there is an existing lease, we don't necessarily need to worry about it if it's less than what they're going to rent it for. So all we need to do is get a statement from the buyer saying, I'm going to rent it for $1,500 a month. And then we get the appraiser to do what's called a comparable rent schedule. They have access to rents in the area, and they look at, okay, is this single family residence 1,200 square feet, 3 bedrooms, 1.5 baths? Does that rent for $1,500 a month or more? And then if they give it back to us saying, yes, it's actually could rent for $1,800 or $2,000, and our mortgage payment is $1,200, then we're good. And right now, because of the way the rents are, we're not running into a situation where the rent is in any way, shape, or form not supporting the mortgage.
So then what down payment would the investor have to have?
It depends. And that's another good question, because you can do as little as 15% down. And it doesn't have any PMI. So PMI is mortgage insurance. It's anytime you put less than 20% down towards a property, mortgage lenders do charge PMI. This program, because of the fact that it's a non-conventional mortgage loan program, there's no companies that are insuring these. So it's 15% down with no PMI. Now, the rates do get a little ugly, for lack of a better word, at 15% down. but it's still viable. And I've actually helped people to take a look at the cash flow, knowing because most agents can help with what a property is going to rent for before you even make an offer.
Mm-hmm.
And then we can sit down, I can say, okay, yeah, your rate may be X, and it may end up with a payment that's a little higher than what you're comfortable with for now, but it's going to rent for well more than that, at least in the short term. And then you can always turn around, because once it cash flows, and I mean, if this is your first investment property, a DSCR is a great route to go. But if you start to cash flow and you start to acquire more properties, then you can show that through traditional ways of income verification through tax returns.
Mm-hmm.
And then as soon as you can verify through tax returns, then we're back into conventional financing at market rate. And the rates for investment properties, really, because we've been in a weird time ever since COVID, mortgage rates have been just weird. And I hate to say it like that, but we used to always have a 0 point option on pretty much every program. Now most lenders, and I talk to a lot of lenders because I'm involved with the State Mortgage Bankers Association and the local, so I know kind of what other people are offering. Those 0 point options just have been gone for so long. So it might be a little bit more money up front for an investment property, but your rate is pretty close to market. So you might have a little bit more prepaid interest. And then you can pay a little bit more at closing to have a market rate for now. And then most lenders will do some sort of a refinance option. I know that's been a big question too, is where are the rates headed?
That was it. That was the next question we were
Yeah.
going to go to. So
Yeah.
And have you seen a change since like the election this year?
No, that's a good question. So everything, and I subscribe to a couple of different programs and listen to some great economists. One of them is Barry Habib. He's been involved in mortgage forecasting and models and everything for a long time. And he said, and again, this was just not too long ago, I saw him speak in Texas, and he said it didn't matter who won the election. The rates were going to be headed in a certain direction. And that was down eventually.
mm-hmm.
But in the short term, it was going to be up. And because ultimately, and I've had this, all politics aside, because I never talk about politics when it comes to business at all. My political views are my own. But monetary policy is not set by the president. So regardless of what you have, strong words by either candidate, they're going to be going with monetary policy that's set by Jerome Powell, from the Federal Reserve. So, and he's been widely criticized on making some not so great moves when it came to inflationary pressures in the beginning because of COVID, and then also kind of waiting and maybe being a little bit too aggressive now. But at the end of the day, he's a very smart man, and his board of governors are very intelligent people too, and they set monetary policy, and they're all in there for another 2 years. So really, Jerome Powell was asked if he was asked to step aside, would he? And he said no.
But he was appointed by Trump in the first term, right?
He was actually appointed. He's an Obama appointee.
Okay.
And they're appointed for 8 years, I believe.
That's
so
what I
that
thought, yeah.
it's to outlive a particular president.
Mm-hmm.
But he was originally appointed by Obama, and then he was reappointed. But that is a good point. He was reappointed by Trump during his first term.
Okay.
And then they clashed because President Trump did say that he felt like the president should have more pressure over monetary policy. A lot of economists have said that that's not good, because to have one person saying, okay, having that much pressure over, let's drop the rates, let's raise the rates. And then back to rates. So the Federal Reserve really just sets what's called the overnight rate. So that's the short-term lending rates. They don't directly impact mortgage rates. They do have an impact on mortgage rates, but the Federal Reserve says they dropped 50 basis points or 0.5% in their overnight rate. That did not translate to half a point. As a matter of fact, most of that movement was already built in because everyone knew that's what he was going to do.
Which is what we saw and what our market saw. And people were like, well, wait a minute, they just lowered the rates. Yeah, it doesn't work like that. It was already going down.
I thought he lowered it more, though, than what people were predicting.
So, yes, people wanted him to do 25 or a quarter. Everyone pretty much knew that he had it in his mind to do half. So there was some criticism about, again, the movement being a little bit too robust, but and really it was almost unanimous. There was one of his board of governors that said a quarter. Everyone else said 50 basis points, and they're also, it's loose lips. It seems to be that it's getting out there because they'll speak. These people will speak at various financial gathering, and 2 days before, they'll say, okay, this is what's going to happen. Well, okay. So then Jerome Powell comes out there and he announces it. He's like, okay, well, yeah, this is a little bit late because we've already heard it.
Right.
It's interesting though. And I think that's also part of why our market is so different right now, because information travels so fast, and mortgage rates and really our whole world is based on the market. So, with that information sharing, and then some of it maybe not legally shared, people being a little bit inside
reactive to it,
and being a little bit too reactive, and then one person who may have a little bit more information about it jumps out there, and then it's
everywhere.
Then I mean
you can't put it back in the bag.
You can't once it's out there. So it's going to be an interesting time once the transition, but everything points back to that was a very long answer for quite a simple question about rates. But so the housing finance agencies really want, and that's Fannie, Freddie, and Ginnie Mae for the government loans. USDA, they really want the rates to be, at least in the short term, down to the fives, and then maybe long term into the low fives, upper fours, and no lower.
Right.
And I have this conversation all the time with people about, well, what about the rates in the twos? So we had rates in the twos and the threes during COVID. That was a perfect model to create inflation, which is what happened. So they had very inexpensive money through low mortgage rates or low long-term rates. And then they also had free money through PPP funds for the businesses, and then stimulus checks for all those people under a certain level of income, which was a little too high, and they didn't have a needs test because, some people, I've got good friends that just did not need that little stimulus check, but took it and then just put it in savings. So didn't actually spend it. And then you also had a broken supply chain. So we had
the perfect storm of everything, right?
Yeah, to get inflation. So we had, you couldn't get goods. People had more money to spend on goods. So they were paying more because of the fact that the goods were not plentiful. And so, and that's another criticism of Powell, is that he allowed the inflation to get to over 9%. Right. It's close to 10%. And he said he didn't want to cool it off because of COVID, because we were still coming out of COVID. We were still coming out of that high unemployment and all that. And he still reacted a little bit too late because 9% was painful.
Right.
And it also, I think it led to a lot of people, a lot of dismay actually in the world in general, but particularly in the United States, because you see the goods and services going up to be so expensive.
And it was like a drastic up.
It was
really fast.
It was within a year. Yeah. Because it went from inflation there. Inflation was very, very, very low at the beginning of 21 to the end of 21, which was when it went to 9.4, I think.
Well, even not mortgage rates, but I own a small business, so our starting pay was still $8-10 an hour, and then by the end of that year we were at $15, $16, $17 an hour, and then even like the price of steel went up 300% over that time too.
Yes.
So our
and it was everything
we were selling is now I've got to add in my employee salaries and the price of everything and gas and all of that, where our it's handrails is what we do. So where it used to be $50 a foot, now I'm at $120 a foot.
Yeah.
And that's the reality in the housing industry, every sector of it, from construction to the lending to all of the aspects and for the consumers, what they see every day. It's not just in one thing where, gas is high this week. No, it's gas, it's electric, it's the gas you put in your car, it's your groceries that you're buying. Oh, I know, I'm looking at a house, and everything is just escalated. So it was across the board. And I don't know, I don't want to give away my age or anything. Obviously, I'm the older one here, but I remember the last real panic of how high inflation was and the effects of it.
Mm-hmm.
And that's a struggle to realize how much that was an impact then versus what we're dealing with now.
Yeah.
Because it feels like two different worlds.
It does. And I think it's partially, so you're probably talking about late 70s, 1979, 1980. And we also had some energy. So we had energy issues, specifically gasoline. So we had the gas shortages.
Right.
And I remember that because I was, 10, 11 at that time. And then my parents had to move because my dad got relocated for his job to Dayton about that time. It's 1979. And And I remember them actually talking about mortgage rates because my mom was a realtor.
Yeah.
And they said, we don't know that we can afford. So that goes to that affordability ratio that we're skirting right now. That's not so great.
Right.
And so my dad was actually able to assume a VA loan and purchase here, and he didn't serve. So that's another thing why I love VA loans is that it's a great opportunity to sell. Now the assumption process is not easy. Back then it was quite a bit easier, but now it's not. But it still makes sense. And so he was able to get it at 6.5%. Where
they were 18.
They were
18%.
The long-term mortgage rates were in the teens, in the upper teens. And people were.
I've never heard of that in my lifetime.
It's crazy. It is really crazy. That period of time was rough.
But I feel like the difference is the average person made what? $80,000 to $100,000 a year, but the average price was
not back then.
40 to 60.
But the purchase price was less. So purchase prices, just as an example, because
I don't mean like person, I mean like household income.
Right.
Well, around there.
But usually in my household, it was one person working.
Okay.
So, and he had a good job. So my dad worked a factory job at Delco. So he was making good money. Good money then is nothing compared to good money now.
Yeah.
But the cost of everything, so you have to figure everything on a scale at that point. If they were really making half or maybe a third of the money that they make now for that same position, costs were, in that case, I remember my parents talking, they had an 18% mortgage on our home, but the purchase price of the home was less than $70,000 for a 3-bedroom, 2-bath home.
Yeah.
You can't find that now without needing a whole lot of work, right?
And even out of college, the average person is making between $50,000 and $60,000 a year.
Right. Yeah.
Sometimes more, most of the time less. And your 3-bedroom, 2-bath home is $225,000, $250,000.
Yeah, it's not. It's definitely not sustainable, and it's pushing some people out of the market. I think my dad made when we relocated back, he made about $30,000 a year.
Yeah.
And the house was 80. So, and it was tight enough that my mom didn't transfer her real estate license to Ohio when we moved here, but she did get a paper route. So she started working other jobs just so that we could make ends meet at the time. And so that is really what's pushing right now that ratio. So, and that's why the HFA the Housing Finance Agency wants to do what they can to spur rates to go a little bit lower, because it's going to help that ratio to come back. So your first time home buyer that's making $60,000 a year right out of college can still buy an affordable home. And then back to the cost to build, the builders it's really the only builders that are actually able to buy something that might be even remotely affordable are these large what they call production builders. So the ones that are able to do kind of a Henry Ford model and do these cookie cutters, and they have all these people on staff. Those are the only ones that are able to afford to, and they're really coming in at 350 to 400. And then your custom construction is $500,000 to 750 in our area. And that's really to start.
Right.
So, I mean, the $1 million homes, we're seeing that again.
Which in Midwest terms wasn't really something that was here. I mean, Oakwood would have $1 million home, but it wasn't standard to think about $1 million home, just typical, right?
Yeah.
And it's now almost standard. If you're in the southern suburbs of the Dayton area, you're definitely looking at it. Beaver Creek, if you go towards the base, you've got that going on. I think the consumer, obviously, they want to know, and we get asked this all the time, and I know you don't really want to talk specific interest rates because it changes probably hourly.
Yeah, sometimes it does, yeah.
And so it really won't be as good as when this recording goes out as our podcast, but the idea of when we were seeing the 3% and 4% mortgage rates, we as professionals were telling people, now's the time to buy. Like, this is a very low rate. Because in our experience, we hadn't ever been in a 3% to 4% for mortgage rates for that extended time. Once in a while, you'd get a dip down and you'd say, hey, if you need to refi, this is a great time. But just as on the standard. And I can tell you, we've probably helped place hundreds of people during that time. And as it starts inching towards and you start seeing the little bumps and it keeps going up and it's not adjusting back down, it's like, man, you're probably not going to see this rate anymore. So reality, you're not going to see 3% interest rate.
Yes.
So pre-COVID, what was the interest rate?
Pre-COVID, I mean, the rates were in the fives.
Fives, yeah.
Okay.
And then we had COVID happened, and the Federal Reserve went in to buy mortgage-backed securities, and so that really pushed the mortgage yields, or the mortgage-backed securities yields down, which pushed the rates down. And they continued to do that for a period of time until they decided that we were kind of out of the weeds at that point. And then as soon as they stopped buying, the market just wasn't there and the rates started going up. And the rates went up relatively quickly too, because as soon as you have somebody with the purchasing power of the U.S. federal government, when they step out of that market, there's no one that's going to come in to fill that void.
Right.
And so it just continued to march up. And then, we've got inflation's mostly under control at 2.4, I think we're at right now. So, and I think they could probably do a little bit more to bring inflation down. But I think that whatever they can do to get the rates down, it's going to take a while. So it's not going to be something that we're going to say, okay, by March, we're going to have rates in the fives. We might. I don't think we will, because it's a big ship, and it's something that takes a while to turn. And we've been hovering around the 7.
Which is funny, because we're saying that it came and was so drastic and so quick, but to correct it, to get it back in favor of the consumer, it's going to take a while.
Exactly.
But I think that's good for people to know. If you need to buy and the rates are between 6 and 8% now, if it goes lower, then hopefully your lender is going to work with you and be able to do a refinance, whether that's a one-time refinance offer that they make, or hey, you suck it up because you're going to save the money and you do it, and it's going to save you that much more. But I think that's good for people to have an idea. 68 is probably where we are right now, and we want to get it better. And if it goes below that, then you should feel good. You should know I'm not in a bad situation where if I waited another month or two, it would come down drastically, because I don't think that's going to happen.
Right. Until when the rates started going up and we were seeing them in the upper 6s, low 7s, I just did I downloaded I'm kind of a little bit of a data head. So I downloaded all of the mortgage data by month from Freddie Mac, which they've been compiling it since 1971. And then I just added it all up, divided by the number of months, and came to about 7.5%. So this is before the rates went up. So the average 30-year mortgage rate over from 1971 to today was 7.5%, paying 1%. So 1 point to get that rate. So really a 0 point option would have been 8.
Yeah.
So,
Can you explain the 0-point option?
Yeah. Traditionally, mortgage lenders in practice don't charge any type of prepaid interest to get a specific rate. And that's been my entire career. We've never really done that. Now, when a lender publishes their rates, they're going to publish as close to 1%. So it's 1% of the loan amount, and that's prepaid interest to buy the rate down. That's published, whereas in practice, we don't really see that. And then that's why it's the data from Freddie Mac is as close to 1 point as possible, historical data. But then really when it comes down to it, like most of my clients that I'm working with right now are not paying anything because it doesn't, particularly right now, because people are going to be able to refinance before it makes sense, because it is prepaid interest, it's tax deductible, but it's also buying the rate down by a specific amount. So if the difference in your payment is, say, $25 and you're paying $2,500 to for 1 point, then it's going to take 100 months to recoup that upfront fee. You're going to refinance before that. So that's why I'm advising most of my clients right now not to, depending on where the rates come out. Because back to the weird rates that we talked about earlier, we're seeing this big difference in between a 0-point option and a 1-point option, depending on the day. I mean, I've seen 3/4 of a point or 0.75 in the rate and more just to pay 1 point. Well, that makes a lot of sense.
So do you see a difference in rates more like on Tuesdays or like towards the end of the month?
No, that's a good question. So usually Fridays. Fridays, depending on the market data from the week, mortgage lenders like my company, not all do it this way. We offer what's called weekend rate protection. So in other words, you can lock in a rate all weekend. So that's 2 days of data that's coming from all over the world that can affect the rates, and they can go haywire by Monday. So companies that do have that overnight rate protection or that weekend rate protection, it is common to put a little bit of a buffer in the rates on Fridays. For companies that don't do that, and the company I came for, you couldn't lock in on the weekends. Fridays, you might see a little bit of a bump, but nothing too drastic. But beyond that, you'll see after economic data. Mm-hmm. So after they announce consumer price index, after they announce housing starts, after they announce
unemployment
mm-hmm. is a big one. You'll see little spikes or little drops depending on how the data comes out. The data has been pretty rosy lately. Unemployment's historically low. Inflation is down, so the data, CPI, seems to be pretty under control as well, consumer price index. And so all that data is coming together to be relatively positive, but the mortgage-backed securities market just doesn't seem to be responding to it that much. So the positive data as much as they have in the past.
Right. So I think you were talking about the different programs and everything, and sometimes they may cost a little bit more because they're specialized in mm-hmm. that respect. For self-employed, we know a lot of people are doing side hustles and gigs and things like that. Do you have anything that's geared for that kind of a market?
We do. So we have a 1099 program that is specific to people who just have 1099 income. That's that self-employed income, independent contractor. Mm-hmm. That could even be your Grubhub delivery, your Lyft. And so once they sit down and do their taxes at the end of the year, it's usually on a Schedule C from 1099. They're going to take all these deductions to minimize their tax liability.
Right.
That's smart. I mean, that's what you do when you're self-employed. With this particular program, we would just look at the 1099 income. So that's perfect.
Oh, that's good.
And we can go back a year. Generally speaking, self-employment is going to require 2 full years. This 1099 program is, and really our creative programs, we're all about the exceptions.
Nice.
If it makes sense, if you've got enough other positives, you've got a great credit score, you've got a good down payment, and it just makes sense, we'll make it make sense. But yeah, that's a great program. And then I've got, because I have an underwriting background too, so I have experience in analyzing income, sitting down and taking a look at the tax returns and saying, what is the income stream that we can use? And then helping them to qualify for and put their best foot forward.
Right. So one of the episodes that we've done is, oh, you want to be a realtor? And Ellie asked some questions and everything. And as the realtor, I just need to know the right people to introduce clients to and give a couple of names for lender options. But sometimes the buyer comes to you and they have their own lender already designated, or somebody that they've done an online application with, and we always cringe because we want to get face-to-face with the lender, especially for that expertise, because it really can come down to being able to talk one-on-one with you, and that's not necessarily easy to do over the phone when you start talking about all these financial types of things, the questions. And while I know generally how to qualify somebody as to where they would be based off of income for purchase price, I don't get into the depth of details like you're talking about.
Right.
That is really what I want the lender to parlay over to the client and have that understanding and build that relationship on. Because again, going back to this experience that I've had with you and knowing that if it's not the best program that you have to offer them, that you're going to tell them and be upfront with the client, and that we're going to get them to the right place. Yeah. And I think that speaks really big volumes as far as that goes. But especially now with all of the uncertainty that's coming out of things, the higher prices, I think it really does come down to the best financial decision for the client on the purchase of the home and what the loan program offers them. So I think that's what I would really, our tips for our clients at the end of the day, what we say is, give us your best tip for clients. What would you recommend that to be?
So the best tip for any of my clients is just to make sure that you're comfortable with your team. Whether that be me, and everybody's personality is different. And if somebody comes to me and they like that we have a good team going, then that's great. But at the end of the day, if they're not comfortable with their loan officer, they're not comfortable with their agent, they need to be comfortable enough to say, hey,
right.
Either say, hey, that doesn't make sense, and I always tell all my clients, if you ask me 100 questions a day, I would much, much rather that than you think that A, I don't want to answer your question because I'm too busy for you, or that you should know the answer to the question, because I don't care whether you've bought 100 homes or you've never bought a home before. You don't necessarily know what you don't know.
Right.
So ask questions. And I've had clients take me up on it. I've had clients take me up on, and they'll text me like multiple questions a day. And the big thing is I just want to make sure that they feel 100% comfortable on that. So that's that comfort level of the team, and making sure, ask questions of everybody. Ask title company, their agent, their home inspector, their lender, everybody associated with the whole transaction. Ask as many questions. I mean, how many times have you seen the commercial about going to the doctor and they sit down and they say, do you have any questions? No.
Nope.
Yeah, no. Well, this is important. This is important. This is
right.
most people's largest investment. And
Absolutely.
so you got to be comfortable asking questions.
Absolutely.
And if for whatever reason, any person in that team seems like they don't want to answer the question, or they're evasive, or they don't get back to you. I mean, we're a high-paced industry, and you need somebody to be able to get back with you within a couple of hours, really.
Right.
Faster if possible.
Right. And that's where I say that really comes to play, because when you do an application online with a company with an 800 number or whatever, getting a hold of that same person is going to be next to impossible. Getting a hold of them within a timely manner that might be necessary for the deal that you're trying to put together is also very critical. So.
Yeah, and not to talk about any other companies, but the online lenders have their process now is to do an assembly line, because that's the way that they can do cut the cost quite a bit. So your first person that you're talking to, you may never interact with again.
Right.
And so you're right. You have, with the local loan officer, with a local agent, with the local title company, all that stuff, you have somebody, and you have that one person that's going to be your main point of contact.
Mm-hmm.
And I obviously feel that that's pretty important. And most of the friends of mine who happen to be agents feel the same way.
Well, Ellie, how do you feel?
Yeah, it's really informative. And there's a lot of programs out there that you don't realize when you just hear FHA or conventional. Which one are you going? Well, especially my generation with student loan debt and whatever, don't qualify for the majority of those programs.
Yes. Yeah, student loan debt is something that's another thing that I went down the data route on, and the tuition. And it's really not the student loan part of it, it's the tuition. The tuition went up, has outpaced inflation every year since 1970. And some years double and triple.
Isn't that when the federal government started backing student loans?
Mm-hmm.
Yeah.
Yeah. So the tuition is really where the problem is, and the student loan lenders and the federal government stepped in, filled a void, but really it comes down to the tuition. I've met with a lot of people who have $100,000 in student loan debt and are working at a and good for them, but it's they've got a master's or a PhD and are working for a public school. Mm-hmm. Well, it's a nonprofit, so chances are they're going to get some of it forgiven, but they're not going to get all forgiven. Mm-hmm. Or those people, the ones that I really feel for, are the ones that just didn't finish.
Right.
Don't have a degree, went 3 years to a private school, and have crippling
the debt and no ability to earn the extra because of the diploma or anything. So,
and I mean, I'm a big proponent of the trades, because we don't have enough skilled trade people who, and we as a culture, I think, maybe I think we're going away from it now, but I think 70s, 80s, even 90s was really big on college education. You had to have a college education, and the trades were somehow less than. Mm-hmm. I've got lots of friends who didn't graduate from college and are making more than most other people who have a college degree. And we have a shortage of trades. Mm-hmm. So, I've got a good friend who owns an electrician. They're struggling to find people who are trained electricians.
Right.
And so they're starting apprenticeships. So they're trying that. I've got a friend who owns a plumbing company, and same thing. Luckily, he's finally got the staff that he needs. But yeah, it's been really interesting. So I'm passionate about, you don't need college. I mean, I know a lot of people who do my job that don't have a degree, and that's fine. I happen to have a degree, but I don't know that I used it. It was in English. I spent 4 years learning my own native tongue. So whether that was a good move for me or not, I don't know. I can speak. So
right.
That's
So before we wrap up, I kind of have an off the cuff question.
Yeah.
You talked about USDA loans for a second.
Yes.
And I see a lot on TikTok about USDA loans, and you can get this and, all this pipe dream. Can you explain that? And then I have a follow-up question.
Perfect. Okay. So USDA, people just associate that with a farm. USDA guaranteed rural loans are for rural underserved. So it doesn't necessarily mean a farm, and it can be subdivisions. And if you look on the USDA eligibility map, there are vast areas that would be kind of suburbs that are USDA eligible. And you don't really have to go that far out of, say, Springfield to get into USDA. You go up further north in our area to Miami County, Dark, I think all of Dark County is. And there's definitely some little towns there and some suburbs there too. So it allows for 100% financing on a purchase of a primary residence only. You do have to qualify based on income because it is considered underserved. It's considered a first-time homebuyer program, sort of. You can have owned in the past, but you have to be at or below a specific level of income depending on where the property is. It's around, but in our area, around 90,000. So, and it's everyone in the household. So if you happen to be moving in with a significant other and grandma's coming to live with you too, then you have to use this is the only
grandma's
program,
Social Security is going to be added into it.
You have to add in all of the income. Mm-hmm. Anybody living in the house, you have a 16-year-old that just started a job at the local pool, you have to count that income.
And so it's under 90 or over 90?
It's
Under. Okay.
So you can get to that point that the income level could be too high and it can put it out. And people say, well, I'm just going to say that my boyfriend's not moving in with me. Well, then you're in a situation where it could be considered as mortgage fraud because you're going to sign something saying that there is no other income in the house. So if the boyfriend or the girlfriend's going to move in, or if the 16-year-old does have a job and you just signed something saying that the 16-year-old doesn't have a job, or grandma's not living with us, grandma doesn't have Social Security, then you've signed an affidavit saying that.
So a lot can happen though in 2 years.
For sure.
And that's fine.
Does
if
your loan change then?
No. So if the boyfriend or the girlfriend moves in after the fact, that's totally fine. And because you've signed something at closing that was true and accurate, right? And then, or grandma decides to move in because she can't live on her own anymore. That's totally fine. Because again, you've signed it that it was true and accurate at closing.
Okay. So my follow-up question is, you see a lot of these farms being sold right now, or farm area, rural areas. Are you seeing those areas for the USDA qualifying loans shrinking?
No. Right now, I have not seen USDA redraw their maps in quite some time. They can, theoretically, and I don't know, they can't change it every year, but they can change it over a specified period of time. And I want to say it's every 10 years. I haven't seen the maps change that much. And then there is a whole nother part of the USDA for primary residences that does cover working farms. That's not something that your rank and file loan officer like me would do. There's some other lending that allows for subsidies, and the subsidies can be pretty large. It can be 50% of the sale.
Wow.
So somebody can buy a $200,000 home, get a $100,000 subsidy. That stays on the home for the entire life. And you do have to pay it off when you sell the home. But, and those are just completely, that's direct to USDA. So those programs are aimed at the small business that may be a farmer, where my area is more just kind of the residential.
Okay.
Very interesting.
Yeah. That's something that you hear about, but you don't really know about.
Yeah. And USDA is such a small portion of mortgage lending because, well, in our area, we probably see it a little bit more because we've got some big pockets just around Dayton and a little bit further south and northwest particularly. And so again, back to making sure that your loan officer knows all the programs and can say, okay, let's run this through everything. Let's pull up this address and see if it happens to fall into USDA. Because even if they have money to put down, USDA may make sense because oftentimes it is a little bit lower than market. So the rate is just a little bit lower. They can put 5% down. They still have a smaller mortgage insurance premium than they would for conventional financing, and it may make sense.
Cool. Well, thanks for coming in and
Absolutely.
giving us all this information.
Yeah. We probably have more topics to go over for a future episode. And
yes, I'd love
anytime.
That. Excellent. Thank you.
Thanks for joining us today on the Realty Podcast. If you enjoyed the knowledge and entertainment today, please subscribe and share with your friends. We will be embarking on a journey that bridges the gap between realtors and clients, uncovering the heart and tea of real estate. Thanks for joining us today on the Realty Podcast. If you enjoyed the knowledge and entertainment today, please subscribe and share with your friends. We will be embarking on a journey that bridges the gap between realtors and clients, uncovering the heart and tea of real estate.